Welcome to The Explainer. Today, we're diving into a financial earthquake, the historic June 12, 2026 SpaceX IPO. We're going to peel back the layers of sci-fi tech, high-stakes Wall Street mechanics, and the fierce controversies that fueled the absolute biggest financial spectacle of the decade. Let's get right into it.
Let's start off the bat with this staggering number, $2.1 trillion. That was the day one market cap that instantly crowned Elon Musk the world's very first US dollar trillionaire. It's a milestone that literally redefined global wealth, but the path they took to get there, it was anything but normal.
Okay, here's our roadmap for today. We'll hit the $1 trillion liftoff, Starlink and XAI financials, engineered scarcity on NASDAQ, the regulatory Musk stack, inequality and ethical debates, and wrap up with the post-IPO volatility.
Part 1, the $1 trillion liftoff, setting up the biggest stock debut in history.
After resisting a public listing for years, Musk finally confirmed the IPO plans in December 2025. And what followed was an absolute sprint. We saw a massive XAI merger in February, the prospectus filing in May, all culminating in that explosive June 12th listing where shares priced at $135 and then skyrocketed 19% on day one.
Moving on to Part 2, Starlink and XAI financials.
The engine driving a $1.77 trillion target valuation.
So here's the thing you really need to understand. SpaceX is no longer just a launch company. Starlink is now taking the lion's share of the business, projected to generate $20 billion of SpaceX's estimated $22 to $30 billion total revenue for 2026. Despite the heavy rockets and all the massive media attention, launch services are, they're really just a fraction of the financial engine now.
Just look at this explosion in recurring revenue. Subscriber growth basically went parabolic, jumping from 5 million users in late 2024 to a staggering 17 million by April 2026. Adding roughly 1.5 million users a month creates exactly the kind of predictable subscription revenue that Wall Street just absolutely drools over. But to really push for that record IPO valuation, SpaceX orchestrated a massive all-stock merger with Musk's AI company, XAI, back in February. The ambition here? To literally build AI data centers in space. They're merging Starlink's incredible infrastructure with the immense computational hunger of artificial intelligence. Talk about a sci-fi pitch, right? Part 3, engineered scarcity on NASDAQ, unpacking the actual IPO mechanics. To really get how this played out, let's quickly define public float. It's simply the percentage of a company's shares that are freely available for public trading. Normally, the SEC requires a 10% minimum. But SpaceX managed to secure a waiver and deliberately restricted supply to roughly 5% on day one. So you have to ask yourself, how did such a tiny pool of available shares interact with massive institutional demand? Well, the simple answer is it artificially inflated the opening price. When you tightly constrain supply like that on a highly anticipated asset, the price inevitably surges. It's economics 101, but played out on a $1 trillion stage.
Here's exactly how they engineered that surge. First, a custom NASDAQ rule change shortened the standard waiting period, allowing SpaceX into the NASDAQ 100 just 15 days after the IPO. This triggered mandatory purchases by major index funds, meaning if you have a standard passive retirement account, your 401k fund was likely forced to buy in at these artificially engineered sky-high prices right out of the gate.
On top of all that, a dual-class share structure ensured that Musk retained an absolute iron grip on the company. Public retail investors got Class A shares with 1 vote per share, while Musk held Class B shares with 10 votes each. That gave him 82% of the total voting power, despite holding a diluted economic stake. Part 4, the regulatory Musk stack, the hidden moats of a megacorporation. Policy analysts call this the Musk stack, revealing that about 40% of Starlink's massive competitive moat is built purely on regulatory assets. Take the $17 billion EchoStar deal, for instance. This wasn't just about buying hardware. It was about buying critical spectrum rights, backed by a team of lawyers to legally lock out the competition. Combine that with highly favorable corporate tax provisions and a huge reliance on U.S. government contracts, and you've got an incredibly insulated, almost bulletproof business. Part 5, inequality and ethical debates. The socio-economic fallout of the trillionaire milestone. Naturally, this unprecedented concentration of wealth ignited a fierce ethical debate. Critics, like the advocacy group Oxfam America, argue this extreme wealth concentration was fueled by regressive tax policies. They point to alleged conflicts of interest, particularly during Musk's time heading the government's Doge Commission, asserting that public policy decisions directly enriched a private individual to a degree we've literally never seen before.
On the flip side, financial analysts justify the valuation by looking strictly at market deliverables. They view SpaceX as a low Earth orbit monopolist. In their eyes, the company is successfully delivering unheard-of data capacity across the globe, fundamentally rewiring global communications. To them, the trillion-dollar price tag just reflects real-world technological dominance. To put those two viewpoints into perspective, get a load of this. Over the prior year leading up to the IPO, Musk's wealth grew by over $1 million every single minute. That single trillion-dollar fortune is equivalent to the wealth of the poorest 46% of the global population combined. Think about that for a second. Around 3.8 billion people.
Part 6. The Post-IPO Volatility, Losing the Trillionaire Crown. But as they say, gravity always wins. The stock opened at $135 and shot up to an incredible $225. Yet, just 2 weeks later, it faced 5 consecutive days of tumbling back down into the sub-$170 range. In the blink of an eye, Musk was stripped of his newly minted trillionaire status.
So what popped the bubble? Really, it was the sobering reality of cash burn. Despite Starlink's incredibly strong cash flow, SpaceX overall is not currently profitable. The combined company absorbed an $8 billion cash burn from XAI, plus the goal of funding 20 billion orbital data centers carries incredibly high execution risk. Wall Street suddenly woke up to the massive, massive costs of these futuristic ambitions.
As we wrap up this explainer, I want to leave you with a final thought to chew on. When private space ambitions, which are now deeply entangled with global public infrastructure, collide with the aggressive mechanics of public equity, what does that actually mean for the future of our markets? It's a massive question we'll undoubtedly be answering for years to come. Thanks for joining me, and keep questioning the mechanics behind the headlines.